Hey guys, my name's Jose, and this is another episode of Buy or Pass. In this series, I will look at the financial documents of a company and decide if I was looking for another investment, would I buy or pass? Before we start, don't forget to hit that subscribe button to get info on new episodes and other videos. So let's begin. Alright guys, so this is going to be the part 3 of Buy or Pass for Apple. On part 3, we're going to look at the financial numbers of Q1 for 2019. Just a quick introduction for all the information. I'm going to be using LazyFA.com, which is a great website to look at all the financial numbers in an easy visual format. So definitely check them out. This is a 3-part episode. A few days ago, we took a look at the 10Q report. A few days after, we took a look at the earnings transcript. And now we're going to look at the numbers of the company. The reason I'm doing it this way is because in the 10Q, I saw everything in an unbiased format since it's just numbers and charts. In the earnings transcript, I had some knowledge on the company, and I was able to see how the leadership was able to deliver that knowledge to the customers. And finally, today we're going to take a look at the numbers now that we have all the information collected. So here we are on LazyFA.com, and we're going to take a look at the quarterly data of Apple. The reason we're going to take a look at quarterly is because quarter 1 just passed by. So here we're going to take a look at revenue. In the income statement, we're going to take a look at revenue, cost of revenue, gross profit, net income, and earnings per basic share. Here in the revenue, we can see it's pretty high pretty similar to the past Q1s of each quarter. Right now it's at 84.31 billion. We saw that there was a down from last year's 88.29 billion, but it's still higher than 2 years ago when it was at 78.35 billion. The company revenue is still pretty strong. Cost of revenue is going up there with revenue itself. This year, this quarter was 52.28 billion. Last year, same quarter was 54. Obviously, there were more revenue last year, so obviously more cost of revenue with more transaction costs and stuff like that. And then 2 years ago was 48.17 billion. Now here we're going to take a look. Gross profit again still pretty high compared to previous quarters, and same quarter last year still higher than that except of last year. So this year is at 32 billion. Last year was 33.9 billion, but 2 years ago was 30.2 billion. So we're still higher than 2 years ago, which is good to know. Net income. So net income right now it's sitting pretty on par with last year's. Last year was 20.07 billion. This year was 19.96 billion, about $0.1 billion less. But we did see in part 1 of this video that this company is paying about $3 billion less in taxes compared to last year. So if we take away that 3 billion, if we take that 3 billion from taxes, this would be about 17 billion, which would be on par from to the previous 2 years ago. 2 years ago was 17.89 billion. So it's just something to note, right, that this company is paying less in taxes compared to last year, and that's why its net income it's pretty on par from this year. But it doesn't mean it's doing as good as last year. So that's definitely something to keep an eye out for. And then earnings per basic share, right now it's earnings that is an all-time high of $4.22 compared to last year's $3.92. Next, we'll take a look at LazyFA has something called red flags, which just lets us see the same information we saw in different format. So here we can see revenue is always much higher than cost of revenue in each of the previous quarters, and no difference here, especially in quarter 1. Quarter 1 seems to be their biggest hit of the year, and again we saw revenue at high and cost of revenue way below it. We can see this gross profit quarterly still pretty high. Again, quarter 1 shows that strength, and we can see gross profit like we saw in the previous slides. Revenue versus cost of growth, we can see it's almost a 1-to-1 ratio in the quarterly, where revenue grows 1% where revenue and cost of revenue grow almost 1-to-1 ratio. Next, we'll take a look at gross margin versus profit margin, see if anything is different there. Gross profit margin is a little higher compared to previous quarters, but it's still on par on average. So it's sitting about 22.6. Same with gross margin. We can see here it's within its average of where it's been the past few quarters. LazyFA does this great thing where it gives us some red flags, something to take a look extra. It doesn't really, sometimes they don't mean anything specific, but it just gives you an extra eye to take a look at. So here right now we have a flag that tells us average cost growth outweighs average revenue growth. So here's just telling us that the cost growth is growing at a higher pace than revenue growth. And here, like I mentioned previously, right, we're seeing a 1-to-1 ratio. There might be a few quarters where revenue, cost of revenue is growing faster than revenue, but on most quarters it's a 1-to-1 ratio. So there's nothing for me to really take a look at here. But definitely LazyFA gives us those great red flags. Next, we'll take a look at the balance sheet. In the balance sheet, we're going to take a look at total assets, total liabilities, total debt, cash and cash equivalents, receivables, and payables. So here we can see assets throughout the quarters. It is at its uptrend, even though in the past few quarters it's been kind of flat, but overall we can still see this uptrend happening. Unfortunately, liabilities and debt had that same uptrend happening. Liabilities this quarter were 255 billion, where last quarter was 258. So it is paying down a little bit, and here we can see total debt being paid down a bit too. So right now this quarter was 114.73 billion. The past 2 quarters have been the same, but 3 quarters ago is at 121.84 billion. So it is paying down that total debt. Receivables, the amount of money this company receives per form of loans or anything, it's pretty high amount. We can see again it has this nice current uptrend, and right now it has about $37 billion of receivable this past quarter, and the payables it has 44.29. So it's almost a 1-to-1 ratio. So usually I can cross these off, and this is nothing outrageous. If we take a look at previous quarter, 1, 2, 3, 4, they were paying a lot more last year same quarter, which is good to see, right? They're not paying as much to its vendors compared to previous quarters. So they reduced the amount of probably supplies they needed. And then unfortunately with receivables, they are collecting a lot less receivables compared to last quarter. Cash and cash equivalents almost at an all-time high, sitting at $44.77 billion of cash and cash equivalents. And I broke down how that cash and cash equivalents is broken down in the previous parts. I think that was part 1. Next, we'll take a look at red flags for balance sheet. So here we can see assets and liabilities. Assets, again, all-time high, always higher compared to liabilities. Unfortunately, it does seem like liabilities are increasing at a faster rate than assets. They seem to be catching up closer and closer each time to assets. Shareholder equity, again, it's kind of a little below its average. I would say its average would be somewhere about $121 billion compared to all these right here. Where right now we're sitting about $117, $118 billion. The shareholder equity has decreased a little bit, but no, not too far from its average, in my opinion. If we scroll down, next we want to take a look at asset distribution. So I do like its asset distribution, how most of its assets are non-current investments. So it's just investments that are not due anytime soon. And then that's 55%. We have the next biggest is 13% on current investments, and the next 7% is on cash and cash equivalents. So I definitely like this. There's definitely the company's assets are investments, unlike other companies where a majority of their assets are property, plants, equipments, and inventory. This company's assets is true assets with investment wise. So I definitely like to see, and we can see its non-current investment increasing over time, and it since A quarter ago it was 194, where now it's 207 billion. So we definitely see that increase. Then we can see its liability distribution. If we take a look at it, 56% of its liability distribution is non-current debt at 56.5%. The next biggest chunk is payables at 26%, and followed by current debt at 13%. But we can see its payables have been, it's more of a cyclical type pattern, and right now it's at all-time low, but we might see it higher. We can see its non-current debt has been paid out in the past few quarters, where it peaked on, what year was this? It peaked on last year, 2017, 12/31, and if we take a look at it, 2018, 12/31, it has decreased by almost from 103 billion to 92 billion. So almost a 10% decrease in non-current debt. So that's definitely great to see on the liability distribution. Next, we have a few red flags that LazyFA gives us here. So current ratio deterioration. I really like this red flag. It's telling us that, so current ratio, right? The current ratio is the ratio between assets to liabilities. So the higher this ratio is, that means the more assets this company has to compare to liabilities. And if we take a look at the annual, right, throughout the year, it has been decreasing. It was at an all-time high in 2009, where it had a current ratio of about 2.7. Right now it has a current ratio of 1.13. So throughout these years, this company has been increasing its liabilities and not increasing its assets at a similar pattern. So right now, again, it's sitting at about 1.3, and this is definitely a good flag to take a note on, and it's something I'll be taking a look at in the future quarters as well. But at the moment, a 1-to-1 ratio is not too bad, especially for a company that mainly of its assets are based on investments and non-current investments. What other flags do we have? Here we have liability growth increases asset growth. So here it just tells us that liability growth is growing at a faster rate than assets, and that's kind of similar to that current ratio flag we had. Next, we have outlier in debt load growth, and this just telling us that its debt has grown out significantly. And we can see in the late of 2014 was when this company first took out a long debt, and it's been decreasing over time, the amount of growth of debt, but it's still good to know that this company has just been increasing its total debt over time. So these are great flags, but the only one I really like out of here was the current ratio deterioration, and this one I'm going to keep an eye out for the next quarters. Finally, we're going to take a look at cash flow statement, the third page, and the only one I care about here is net cash flow from operations, and we have a positive net cash flow from operation of $26.67 billion, and we can see it's on par from previous quarters. It might be a little lower, a few $0.5 billion, but it's still on average compared to previous quarters of the same quarter in years back. Next, we'll just take a look at metrics, and this is the last thing we'll take a look at. Price to earnings ratio is about 12.73. Right now, I did the math compared to what the stock price is at today. It's at 175. I took the previous 4 earnings, and right now it's at a 14.25 price to earnings ratio, which is still pretty low compared to most quarters. So that's definitely a good thing. Unfortunately, we did see this debt to equity ratio increasing, and it is continued to increase. I definitely don't like to see that. All right, so let's just take a quick overview before we make our decision. Revenue increasing, cost of revenue increasing, gross profit also increasing, net income pretty on par with previous quarters. So it all depends on how the next quarter goes to see if the slowdown is happening or not. But right now, it's not giving me right now, income statement is giving me that this is a healthy company. It does have a slowdown, but nothing crazy in the slowdown. If we take a look at the balance sheet, in the quarterly, we see total assets increasing. Unfortunately, we see those total liabilities increasing as well. But that cash and cash equivalents is definitely super healthy. And again, this is still a pretty healthy company, and nothing is really giving me that thing to not buy. We saw that asset distribution, and we saw how a majority of that asset distribution is based on investments, and that's good to see. Where most, like I mentioned before, most companies asset distribution is like 50% plants and equipments and inventory, where this is actual investments based on assets. Cash and cash flow statements, we saw that positive cash flow from operations. And metrics, we took a look at its price to earnings ratio right now. It's pretty cheap compared to previous quarters, sitting at about a 14.25 price to earning ratio, which is pretty good. Unfortunately, we have that debt to equity ratio. After looking at all the company's previous information, we saw that this company is trying to get rid of, well, it's trying to decrease its dependence on the iPhone sales and increase its service sales. And we've seen that previous years it has increased over time. So for that reason, and the numbers again are looking pretty healthy compared to previous years. They are not looking exceptional compared, obviously, because of the slowdown, but they are still looking pretty healthy. And with all the things mentioned in the previous parts 1, part 2, like I said, that dependence on iPhone sales is pretty big right now. So if this company keeps increasing its sales and revenues based on other services and other products, this company is gonna definitely do good. And for that, I'm gonna give Apple a buy. So I hope you guys enjoyed the episode. Like I mentioned, LazyFA makes it so easy to look at all the information, which makes these episodes go pretty fast. I'm curious, would you buy or pass in this company? I hope you guys enjoyed this episode. Like I mentioned, LazyFA makes these numbers look so clear and so easy that makes the episode go pretty fast. I hope you guys enjoyed the 3-part where we took a look at all different parts of the company at the 10Q, earnings transcript, and now the actual numbers. So I'm curious, would you buy or pass on Apple based on the information we saw in the previous episodes? Again, don't forget to hit that subscribe button to get updates on new videos and other episodes. Have a good night, guys, and see you next time.